Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Good morning. Last week of February 24th. Going to get started this morning. A lot going on this morning in financial markets. We saw the impact last week at the beginning of some concerns really starting to impact the markets with respect to coronavirus. And this morning we're seeing those fears significantly heightened after reports that the virus has spread more significantly outside of China. So we're going to talk about that. Most importantly, so with the uncertainty that's taken place in the market, wonderful time for advisors and market participants to make sure that their portfolios are in line with their risk assessments. We had lots of ebullient and buoyant feelings take place over the past several months, and those were constantly reinforced by an ever-rising market. So with this disconnect that we're seeing this morning, it's just a great time to just revisit. Maybe changes are appropriate, maybe they're not, but a wonderful opportunity to connect and to have meaningful conversations. So I'm going to get started this morning talking about a book that I've been reading and some concepts I think are critically important to think about, and wanted to share some of those thoughts from this book that I was reading. The name of the book is Peak: Secrets from the New Science of Expertise. And the thesis here is, what does it take in order to be amongst the best at anything? It could be amongst the best at being an investor, being a financial advisor. It could be mountain climbing. It could be basketball. It could be being an executive or a CEO of a company. And the author here, Anders Ericsson and Robert Poole, were out to study what it takes to be amongst the elite. And the findings were very surprising, and I thought that would be great food for thought for all of us, both in our professional careers, in our personal lives, to reassess and to think about what it takes to be successful in any endeavor. And one of the most common thoughts that people have is that when they see tremendous success, perhaps Michael Jordan on the basketball court, perhaps a CEO who like a Steve Jobs or a John Chambers, to say, hey, those people just have a natural ability. They have a natural ability to be intelligent. They have a natural ability to connect with people. They have a natural ability to jump fantastically, to shoot a basketball fantastically, to run faster than any other person out there. And some things are innate, especially when it comes to athletics. There are certain components like height and strength that are benefits. But in most endeavors, it really comes down to practice and purposeful, meaningful practice. And what researchers have discovered and come to realize is that even adult brains are far more adaptable than anyone ever imagined, and that we have tremendous amount of control over what our brains are able to do, and that the brain responds to the right sorts of triggers and actually rewires itself in various ways. And this is something that is similar to the way the body reacts to stress. For example, when someone is weightlifting or bodybuilding, you take the body beyond a certain point in a very directed, purposeful manner. Perhaps you're working on the strength of your legs or the size of your biceps. You would go out and you would seek to push that muscle just a little bit beyond what you've pushed it before, so that you're straining it and stressing it, but not to the point of injury. And then the body is able to increase the amount of blood flow to that area. It learns that there's a stress there, and it builds further muscle. And the mind works in a very similar way, because the bicep is a muscle, the chest muscle is a muscle, and the brain is a muscle. So it's that dedicated training that makes it possible for us to do things that we otherwise would not do. And speaking of athletics, the book talks about Ray Allen. Ray Allen, perhaps one of the best three-point shooters in NBA history. Ray Allen, probably more than any other athlete, went on to define the three-point shot and make the three-point shot in basketball perhaps a key signature part of the game that it wasn't prior to his success. And many commentators have referred to Ray Allen as having a born touch, a natural shot. And Ray Allen, over the course of his career, said that he was very frustrated and very unhappy when he heard that. He said, in fact, when he was in college, he was a significantly below average shooter. And he says, I've argued this with a lot of people in all my life. When people say God blessed me with a beautiful jump shot, he said, it really pisses me off. I tell those people, don't undermine the work I've put in every day. Not some days, every day. Ask anyone who has been on a team with me who shoots the most, who's out on the court the most, who's up earliest in the morning, who's out taking the most jump shots, who's taking the most three-point shots. It's me. So Ray Allen, again, lots of times we see success and we say to ourselves, hey, that success is innate, it's natural, because it looks so good, it looks so fluid, because there was so much practice that went into it before we got to that level. And here's an interesting study. I'll leave you with this, and then we'll move on to the financial markets. But during the Vietnam War, in the early stages of the Vietnam War in 1966, 1967, the U.S. was shooting down Russian-trained North Vietnamese fighter pilots at a ratio of 2-to-1 versus Russian-trained pilots fighting MiGs. And what they discovered come 1968 is the Russians had trained the pilots from North Korea even better than they had been trained before. There had been some improvements to the MiG fighter jet, and the ratio fell to 1-to-1. The U.S. was losing a lot of pilots. So what did the U.S. do in response? The U.S. started the Top Gun program. The U.S. did not change any of the fighter jets that the U.S. was flying. They started the Top Gun program, and what did they do when they started the Top Gun program? Is they took the absolute best fighter pilots that the U.S. had, and they made those pilots the Red Force. And the Red Force was those who were fighting the U.S., and they had them train on MiGs. And then they took the incoming class of Navy fighter pilots, and they put them on the blue team. And they had the blue team go up against the red team. And they analyzed every single aspect of the dogfight that was in a simulation. And when I say a simulation, it was actually in in jets, just without live ammunition. But these were jets that were being pushed to the max. And if you saw a Top Gun movie, there were fatalities, although the goal obviously was to train and not to train with fatalities. But if you want to push to the max, there's going to be risks that are undertaken. And they analyzed every single dogfight, and what they discovered was that by that meaningful, purposeful learning, that the fighter pilots, in every scenario that they were encountering, if they learned how to react in that different scenario, that they would have greater success. And what happened at the end of the Top Gun program when they released those fighter pilots out into the field in 1970, the U.S. kill ratio versus the North Vietnamese, which had gone from 2-to-1 to 1-to-1, was 12-to-1. Again, no change in anything other than the training. And the key component here is that the training cannot be simply just practice without purposeful, mindful thinking of how you are going to improve. The studies showed that if you just went through the motions or you just practiced, but you weren't practicing to push yourself further, the benefits were very, very minimal. But when the practice was purposeful, meaningful, and created a mental representation of the success that you wish to achieve and had a meaningful guided path to achieve that success, with the help of coaches who had the ability to teach properly and to teach shortcuts, that the success rates were tremendous. And that mindful growth is possible not just when it comes to fighter jets, but in just about any discipline or aspect of training, whether it be physical or mental. So hopefully you can put your best Top Gun forward today as you take a look at the financial markets and able to maintain that cool that we saw perhaps in the movie, that ice band cool, because today is going to be a day to be really have the opportunity to add value and to connect with some people who may not be thinking as clearly. So right now we have S&P futures. Last I looked, we're down about 85 points below fair value, trading about 2.5% below fair value, as an increase in the outbreaks of coronavirus reported outside of China have exacerbated growth and valuation concerns. South Korea, Italy, and Iran are among the countries with a reported surge in new coronavirus cases, prompting increased government action to protect citizens. South Korean market was down about 4% Monday. Italy right now is down about 4.5%. Good news, which the market's not focusing on today, is cases are reportedly slowing down in China, which may explain why the Shanghai Composite declined only 0.3%, but concerns are that the coronavirus could potentially spread meaningfully outside of China and could impact the global economy. Chinese President Xi described the virus as the country's fastest spreading health crisis, but he also said that the impact is, quote, short-term and overall controllable. U.S. Secretary Mnuchin said he doesn't expect the coronavirus to have a material impact on the Phase 1 trade deal at this time. Nevertheless, other parts of the market are rallying in the flight to safety trades. Gold is up about $35 an ounce to almost $1,700 an ounce. Treasuries are rallying. 2-year yields down 7 basis points to 128. 10-year yield down 8 basis points to 139. Dollar up slightly against most currencies. Crude oil down over $2 a barrel. And the volatility index, the SIBO volatility index, is up about 30+% to 22.5 as investors assume protection against further weakness in equities. Some companies in the news this morning. Intuit this morning, it's down a little over 3% as the company nears a deal to purchase Credit Karma for $7 billion. We are seeing strength in some of the gold producers. Newmont Mining, for example, is up about 6%. They had earnings last week, and the strength in gold this morning adding to the strength in Newmont Mining. And we have some of the chip stocks like Advanced Micro Devices, to name one, down about 7% this morning on fears about the coronavirus. Chip makers, especially those that manufacture significantly in Asia, feeling pressure this morning. Moving on to a couple of other stories, couple of other facts. Additional concerns with respect to the U.S. economy having to do with the ongoing stoppage of the 737 MAX at Boeing, and concerns that is starting to have a very meaningful effect on the U.S. economy. Insiders note an eerie calm at Boeing's 737 MAX factory, formerly a bustling hub that has helped fuel the aviation industry's record growth over the last 2 decades. So you put coronavirus on top of some of the weakness that's taken place in the U.S. manufacturing space, largely as a result of Boeing, and Boeing has a significant trickle-down effect, and you could start seeing some real weakness in some of the indicators having to do with the economy, and we saw that on Friday, where we got the market level of manufacturing falling below 50, and that was one of the reasons that we saw weakness on Friday, and we're seeing that carrying through this morning. This morning, Warren Buffett is on CNBC. He was out with his annual report over the weekend. Warren Buffett now is going to be turning 90 this year. So concerns about his age, but still on CNBC this morning and offering some of his thoughts and thought-provoking commentary. He was out this morning saying that Apple is probably the best business I know in the world. Berkshire owns over 5% of Apple. He said that Berkshire, in his opinion, is worth the same with or without him, especially now that he's 90 years old. My value added is not high, but he said, I don't think I'm subtracting value. He said that bank stocks are very attractive compared to most securities. He says he feels good about the bank stocks that they own. He did make a reference to American public's wild enthusiasm for index funds, compared it to some of the enthusiasm that was seen in the late 60s for conglomerates. Said that the U.S. economy is strong, but a little softer than 6 months ago. Market doesn't like to hear that. Doesn't like to hear that the direction is weaker than it had been before. Something else that may be having a peripheral effect on the market this morning. He wouldn't reveal why he sold Wells Fargo stock. He didn't sell out of the entire position, but decreased the position. But did say we bought Bank of America and sold Wells Fargo, and said that the coronavirus is significantly affecting a percentage of the businesses that Berkshire Hathaway is in or owns. Give you an update here just on the markets right now. We're seeing Dow futures about 800 below fair value, S&P futures about 90 below fair value, Nasdaq about 275 below fair value right now, and 10-year Treasury 139, 30-year Treasury 184. And Brad will talk a little bit more about the bond market in a few minutes. Things to look forward to this week. We get some earnings all week long. Today we get some earnings from HP and Palo Alto Networks. Tomorrow we get Home Depot. Tomorrow also JP Morgan hosts its 2020 Investor Day in New York. Wednesday we get earnings from Lowe's, Marriott, TJX. Marriott may give some insights to what they're seeing in terms of travel with concerns regarding the coronavirus. Thursday we get earnings from Anheuser-Busch InBev, as well as Best Buy. Also on Thursday, we get durable goods report for January. Consensus estimates are for a decline of 0.9%. That's after a jump of 2.4% in December. And then on Friday, we get the Institute for Supply Management releasing the Chicago Purchasing Managers Index for February. Expectations are for a reading of 45, up from 42.5. And if that's the case, it would be the sixth consecutive month the index has been below the expansionary level of 50. Barron's talked about the weakness that we saw on Friday and some concerns regarding the market and concerns regarding the coronavirus. And what Barron's pointed out is that what we're seeing in the markets is an interesting, at least up through today, was an interesting bifurcation taking place. We saw continuing strength in the aggressive technology-oriented stocks, and we saw continued strength in elements of the market that would typically associate with a weaker economy. We see continued strength in treasuries. We see continued strength in gold. We see a record in the utilities index. So what we have is we have market participants either very bullish, at least up through today, and playing and speculating in the most aggressive names, and at the same time we see market participants moving to the sectors that usually are the most resilient in a weak economy, which is an interesting dynamic that you don't see too often, where the two strongest sectors are the two extremes, and the value stocks and the middle is the space that's been the weakest performer, not just in the last week, but over the last 6 to 12 months, and we'll see what the implications of that are. We also had last week the Democratic primary in Nevada, and we got results from New Hampshire, and before that in Iowa, and with Bernie Sanders continuing to show strength. Barron speculating that perhaps some of the optimism that we saw at the end of last week had to do with the markets feeling that the prospects for President Trump being reelected are seen as better, especially better than Bernie Sanders, and at least at the moment, markets perceiving President Trump being more market-friendly than Bernie Sanders. So markets viewing a Trump re-election prospect as something more positive than negative. Barron's also talked about the fact that even though they remain optimistic about the market, especially with interest rates so low, and this is before the sell-off that took place this morning, they did suggest that the market is looking bubbly, not predicting that it's necessarily the end of the bear market, but they did say it's time to prepare for a correction. They said a melt-up is happening right under our noses, although we don't quite have a definite sign that a bubble in equities is forming. Several market statistics are concerning, and they say it might be best to prepare for a post-bubble correction of 10% or more. They say what's going on under the surface looks worrisome. Growth stocks are dominating value stocks, blowing past dot-com era outperformance levels. The last time we got to these levels where growth stocks outperform value stocks by the extent they are today, the bubble burst and 50% of plus global bear market began. And they go on to give some statistics. Trading action in the most popular stocks, the FANGs, Facebook, Apple, Amazon, Netflix, and Alphabet, prior to today were up 10% year to date, added $330 billion in market value to the S&P 500, and trading at 35 times estimated earnings, up from 21 times just 1 year ago. And it's not just the rising valuations that had the authors of this article concerned. They also were looking at the options market. Bullish calls on Microsoft were blowing away volume in bearish put volume. That ratio is up 60% year over year in terms of the amount of call options being purchased versus put options in Microsoft, and that was happening on very elevated volume. Just to give an example, and this is pretty much representative of a lot of the go-go tech stocks, but volume in Microsoft options was up about 60% year over year as well. So what do they suggest doing if you are concerned about valuations? And obviously this is before the action this morning, so some of this advice might change slightly. One, they talked about sector rotation, perhaps taking a look at some beaten down sectors like financials, like energy. Secondarily, if that's not something that you find palatable, perhaps taking some money off the table. Could be painful if the markets rally, but it may be prudent just given the extent of how far markets have come. Put things in perspective, a 10% drop in the S&P 500 would move that index near the 50-day moving near the 200-day moving average. Again, the 200-day moving average on the S&P 500 very extended, and just getting back to the 200-day moving average would be a drop of about 10%. A couple of stocks mentioned positively in Barron's. One was Caterpillar, which has dipped, at least as of Friday, to 137 from 150 at the start of the year, even though market has been up for the year. And they say one of the reasons that they are getting optimistic about Caterpillar is they feel that it could be near a near-term trough for Caterpillar. And they say if they are wrong about their thesis, and they are wrong that the U.S. is not going into recession and actually were to see a slowing in the economy, well then, while you waited, you'd still collect a better than 3% dividend yield. But they say when you take a look at the three businesses that Caterpillar is in, construction equipment, which is something that would benefit perhaps post-election from some money being put into that category known as infrastructure, something that's been talked about a lot. Caterpillar is a major producer of pavers, loaders, excavators, graders, all sorts of things that would be used to build out the infrastructure in this country, would possibly be a beneficiary of that. The second unit that Caterpillar is involved in is one that's very beaten up, and that's energy, producing equipment for the energy industry, and that doesn't include just the pipeline and the exploration companies, but also making engines, turbines, and locomotives to move around a lot of energy in this country, and that's a sector that's significantly out of favor. And then third, is the mining space, and starting to see a little bit of a renaissance in some of the mining sectors, specifically gold and silver. But this is a third sector that's been beaten up, and they suggest perhaps with all three cylinders not firing optimally, perhaps the opportunity is there for a turnaround. Barron's also talked about Warren Buffett and his purchase of Kroger stock, symbol KR, King Roger. Berkshire recently paid $549 million for a 2.3% stake in Kroger, and Barron's suggesting that this was a thoughtful and perhaps a good move by Buffett, speaking positively about Kroger. They talk about the fact that Kroger is growing digital sales 21% year over year. Kroger is selling for less than 13 times earnings. They compare it to Walmart, which has been growing in groceries as well. It's trading at a 45% discount to Walmart. The grocery industry in this country is very spread out. Outside of Kroger, their other players are significantly smaller, so the competitors, there is not a very large other grocery chain out there. You do have competitors like Target and Walmart, certainly, but in terms of pure play groceries, Kroger is twice as large as their number two competitor, which is Albertsons. Kroger maintains a number 1 or 2 position in 90% of its markets. More than 1/4 of its revenue comes from private label goods. This year, the company is expected to clear $1.6 to $1.8 billion in free cash flow. That's after putting $3 billion towards capital investments. And they're doing some innovative things. They're working with Microsoft to build out what they call digital shelf space, which will allow for new revenue from advertising and video analytics to aid in promotion. They are also partnering with Ocado, which is a company that builds automated fulfillment equipment for warehouses. So these are basically robots that go out and get the goods that the customers order. So you don't need to have individuals running all over the stores or the warehouses to get that in order to fulfill orders. So taking on some innovative strategies as well. Lastly, I'll talk about the big deal that took place last week, which was Morgan Stanley purchase of E-Trade, and Barron's talked about the fact that what we see here is we see Wall Street really becoming very involved in Main Street, something that had been previously shunned by the big investment banks. And here you have Morgan Stanley spending $13 billion in an all-stocks deal to buy E-Trade, which is a signal that the elite Wall Street bank will compete aggressively for retail banking and brokerage customers. Combined entity is going to have $44 billion in assets, 8 million customers, $3.1 trillion in client assets. And what you're seeing is Morgan Stanley, as well as Goldman Sachs, investing heavily in reaching out to Main Street. Goldman Sachs started Marcus in 2016. Marcus now has $60 billion in deposits and generates $860 million in revenue. Why are the big banks pursuing this strategy? Because they are suffering from the effects of the post-financial crisis regulation. They have to keep more capital on hand. Trading profits are harder to come by. For several reasons, one of which is that the capital requirements are higher. Secondarily, the spreads are a lot tighter. The flow of information is a lot greater. So the typical profits in trading are drying up, and the banks are looking for alternative areas in order to grow their businesses. At the same time, it's become increasingly more difficult for the big banks to merge in their core areas. If you think about J.P. Morgan, Wells Fargo, Citibank, regulators may not look favorably upon them taking over each other or rivals, as they already have a significant market share, fears of being too big to fail. But there is less concern when you see the big banks entering Main Street, doing acquisitions like Morgan Stanley purchasing E-Trade. What's also interesting when you think about E-Trade is the crown jewel is probably not its brokerage platform. It's probably the banking business, where the deposits or the assets that the brokerage accounts hold. Those clients have been receiving very low interest rates, and they can lend that money out at significantly higher rates. And what you're seeing is that the brokerage business is really quietly turning into the banking business, with an add-on component of low-cost trading, or a component of asset management for higher net worth clients. But where the revenues are being derived and the big returns on equity are being derived is in the banking space, and that's a trend that we are very likely to see continuing. That's everything I've got.
Thank you for listening to Mr. Keith Lanton. For more podcasts, please visit our website, www.lanternwa.com.